In today's video, I'm going to go over the relationship between the income statement and the balance sheet accounts. And for example, when you look at the income statement, you have sales, and as you make sales, that creates accounts receivable. And then you have a movement within the balance sheet accounts from accounts receivable to cash, which is in total referred to as the sales conversion cycle or days sales outstanding. So this is the kind of thing we're going to be going over today, so stick around. And if you're new to this channel, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in the great state of New York. And the purpose of this channel is that I give you my summary of my experience over the last 15 years working in accounting so that you may debit your knowledge, your biggest assets, and credit your self-doubt. Wow, okay, I like that. All right, so you got the income statement and then you got the balance sheet. And the best way I like to describe the relationship between the two is that it's like a novel. It's like Romeo and Juliet, right? Where the income statement is the events of the novel itself. And the balance sheet is how it all ends. The ending of the novel is the balance sheet. And so an example is that on the income statement, you decide to spend a whole bunch of money on marketing in the hopes of increasing the amount of sales, right? And so that's all gonna happen in the business, in the income statement, and then at the end, on the balance sheet, you'll know how the story ends. If the story ends well, meaning the marketing generated more sales, you'll have more cash and more retained earnings on the balance sheet. So the income statement is like the events of the novel, and the balance sheet is like the ending of the novel. All right, now let's jump in and take a look. So if you have the income statement, and as you begin to make sales, that's gonna create accounts receivable, like we said before. Accounts receivable, in turn, is gonna turn into cash as you have credit terms with your customers, say 30 days, 45 days, or whatever you have. So then the accounts receivable is gonna turn into cash, and this cycle here of turning sales into cash is referred to as the sales conversion cycle, or also days sales outstanding, and there's a way to calculate that, so let's take a quick look on how to calculate. All right, so days sales outstanding is an important balance sheet KPI, and the definition of it is that it's the number of days it takes to convert sales into cash. So let's take a look on how to calculate this KPI. So when you look at days sales outstanding, you have to take a formula that takes the accounts receivable balance and divide it by the amount of credit sales, and then you multiply that by the number of days in a period. So if you take an example, if a company has $2 million in accounts receivable, you divide that by the amount of credit sales, let's say $1 million, and then you have multiplied by the number of days in the month. Say this is the month of May, 31 days, you get an answer of 62 days, which is telling you that it's taking you 62 days to convert your sales into cash. And if you're wanting to get deeper into balance sheet KPIs and how to analyze the balance sheet, there are a couple of online courses on my website that get in depth into the subject, so go ahead and check that out. All right, so what about cost of goods sold? So with cost of goods sold, the beginning of the story is with the inventory account. So within the balance sheet, you have a movement from cash to inventory. So you go ahead and buy inventory with cash. Initially, you buy the inventory with accounts payable, and then you go ahead and settle that into cash. But the beginning of the story is on the balance sheet itself. And then as you begin to make sales and as you begin to record your cost of goods sold, that's going to be a relationship between cost of goods sold account and the inventory account. So you're reducing your inventory and increasing your cost of goods sold. And the difference between the cost of your inventory and the amount of markup that you put on your sales is going to be what we refer to as gross profit. And just like we did for days sales outstanding, there is also a formula to calculate days payable outstanding. And days payable outstanding is the number of days it takes from receipt of vendor invoice all the way up to payment. And you want that to be a little bit longer than your DSO. So in this case, to give you an example of the formula would be taking the amount of, or the average accounts payable, and dividing that by cost of goods sold and multiplying that by the number of days in a period. So as an example, if you take accounts payable average balance of $3 million divided by cost of goods sold of $1.2 million, then multiply that by the number of days in the month, which is 31 days, say in the month of May, then you get a number that's going to be 78 days, which is the number of days it takes from receipt of vendor invoice all the way up to payment. And you want that number of days to be higher than your DSO so that you're collecting your cash faster and paying your vendor a little bit slower. All right, after gross profit, we get operating expenses, and the three major buckets here we have payroll, marketing, and software. With payroll, most of the time it's going to be a relationship between the payroll account and the cash account. As you pay your employees, you hit the cash account. You may have some cases where you hit the accrued expenses liability account, when, for example, you are paying your employees every 2 weeks, for example, and then you have maybe 3 or 4 days at the end of the month that you have to accrue for as an accrued liability. So the payroll expense account will be affecting cash on the balance sheet and accrued expenses in some cases. Now, with marketing and software, this is going to be hitting your accounts payable. So as you accrue these expenses with your vendors, you are hitting accounts payable, and then it takes some time depending on your terms with your vendors, say 30 days, 60 days, the settlement is between accounts payable and cash, right? So this is the relationship here from the expense to accounts payable and then over to cash after that. All right, so that's for the majority of operating expenses. What about some of the non-operating expenses? So for example, here, if you have depreciation, and the depreciation here most likely is a depreciation of the corporate office, right? And some of the other equipment, because the other depreciation for this manufacturing company most likely is in cost of goods sold. Say for the equipment that it's making the inventory, then you have that depreciation is going to be in cost of goods sold. But some of the depreciation will be down here under below operating expenses for depreciation that is not for equipment related to production. So for example, a corporate office, like we said. So in this case, the depreciation would be hitting this non-OPEX account, and then the other side on the balance sheet is going to be a contra property, plant and equipment account. That's going to be a negative account that's going to be here netting out and reducing the balance on your property, plant and equipment. Then finally, you have net income. And with net income, as you close the accounting period, you close out and you take that net income and book it into retained earnings. So retained earnings is the accumulation of all of the net income over the month and years as you operate the business, and that becomes part of owner's equity. So as the owners make more and more net income, that gets folded into retained earnings and become their claim in the business, right? And as you can see here, we have total liability and equity. That's going to always equal total assets, and the reason for them to equal is that what the company owns in asset always is going to be equal to what the company owes, right? So what does the company owe? It owes liabilities, it owes it to third parties, and it owes owner's equity. Who does it? The company owe the owner's equity to the owners, right? So the two sides of the balance sheet are balancing for a reason, is that the company owns some stuff, which is the assets, and that's always equal to what the company owes to third parties in terms of liabilities and to the owners in terms of owner's equity. All right, so we'll do a super quick recap here just in case you got distracted by one thing or another. So as the company makes sales, that's going to turn into accounts receivable. Accounts receivable will turn into cash in what's called the sales conversion cycle. Then for cost of goods sold, that's going to be an intra balance sheet movement between cash and inventory as you build more inventory in the business. And then as you sell that inventory, you'll be moving from inventory to cost of goods sold. And that's the difference between sales and cost of goods sold. And the price here is going to be gross profit, right? And then operating expenses, you have payroll. The movement is from payroll to cash mostly, but then you have also some movement to accrued expenses. If you have a number of days at the end of the month, especially, that you need to accrue for payroll that have not yet paid in cash. Now with marketing and software, this kind of expense is going to hit the accounts payable account, and then you're going to settle that into cash after that. And then you have some non-operating expenses like depreciation that's going to be hitting the contra account here. Is going to be accumulated depreciation that's going to be reducing the amount of PP&E or property, plant and equipment. And then you have net income at the end that's going to be closed out into retained earnings at the end of the period, building up the owner's equity in the company. And as an important reminder, I'm going to be teaching live on May 28th. That's going to be live on lighthole.co. It's a class on how to analyze the balance sheet. You can join that class and you can ask me your questions directly. It's going to be 2 sessions. Each one is an hour long, where you get to ask me your questions directly and interact with me directly. And that's it. I hope it's been helpful. If you liked it, go ahead and smash that like button. And if you know someone that can benefit from this video, go ahead and share it with them. And I'll see you in the next one.